Welcome back, everyone. This is Chapter 12, Investing in Stocks. Part 1, we'll look at evaluating stocks, and Part 2, buying and selling stocks. Owning stock. Stock is basically a share of ownership in a publicly owned corporation. As long as the company is publicly owned, you can buy a share of stock in it. Two ways to earn money from stock is through dividends and a capital gain. Dividends are money paid to stockholders from the profits of the company. I like to think of dividends as a thank you. It's kind of like earning interest on holding that stock. The other way to earn a profit is through a capital gain. This gain is recognized once you sell the stock. So for example, if I were to buy a share of Apple stock at, say, $150 and the value increased to $160, I may be up $10 per share. However, it is not a gain until I sell that stock. So again, if I buy the stock for $150 and then I sell it at $160, I earned a $10 gain per share. There are two types of stock that you can buy, common stock and preferred stock. Common stock is, as the word says, common. This is the most common type of stock that you see. When you see news and different television shows referring to stock, the Dow Jones, the New York Stock Exchange, all those different stocks that they reference are common stocks. A common stock can sometimes pay a dividend, and with a common stock, you have what's known as voting rights. So when there's different issues with the company, you have one vote per share of stock that you own. Preferred stock is another type of stock. It's usually less expensive than the common stock. It pays a dividend and it's usually fixed, and it has no voting rights. Preferred stocks are typically less risky than common stocks. They also do not vary in price as much, meaning the prices do not fluctuate. They do not go up and down as much as common stocks usually do. This slide includes all the different types of stocks. There's income, growth, emerging, blue chip, defensive, and cyclical. These are the ways that you can classify stocks. There are income stocks. They are generating an income. That income is in the form of dividends. The next type of stock is a growth stock. A growth stock, the company is hoping to grow over the long run. So what happens with companies is when they earn a profit, they can choose to pay a dividend, then they're an income stock, or they can choose to take that profit and reinvest it into the company in hopes the business will grow. So that type of stock would be considered a growth stock. One example of an income stock is a stock that known as Energy Transfer Partners with the stock symbol ETP. This stock pays a very, very high dividend. It would be deemed an income stock. Another stock that you guys are commonly know of is Amazon, AMZN. Very, very expensive stock price per share. There is no dividend because the CEO believes that he wants to grow the company, so he takes all of that profit and reinvests it into the company. The next two types, emerging and blue chip, are kind of like opposites as well. An emerging stock is a very new company. It's usually a penny stock. It is in a small company. They can be very risky because there's very little history with that stock. Hence the name emerging. It's emerging, it's new. The opposite of that is a blue chip stock. A blue chip stock is a stock in a very large, well-established company with a solid record of profitability. One that you are familiar with would be UPS stores, Walmart stores. There's a company out there called Procter and Gamble. That's a blue chip stock. It's a company that has been around for many years and it has a long track record of solid profitability. The last two, defensive and cyclical stocks, they're kind of like opposites as well. A defensive stock, if you think about it, defensive, it's staying defensive in an economic downturn. So a lot of times this stock will pay a dividend and it usually will remain fairly stable in an economic downturn. So if you think about the companies that you use, no matter if the economy is doing great or not doing so well, as long as it's a consumable item that people use for everyday life, think about different items like craft products. No matter what happens in the economy, people still need to buy food. The opposite of that is a cyclical stock. A cyclical stock is one that runs in a cycle. A lot of times when the economy is doing well, that stock in turn will be doing well. And the opposite is when the economy is not doing well, that stock a lot of times will not do as well. So think about it in a real life perspective. When the economy is doing well, people are spending more money. A lot of times they may go on more vacations. So a company like Royal Caribbean, the cruise line, may see a better stock performance when the economy is doing well, as opposed to when the economy is not doing well. That value of that stock may not be as high. The market value, how you buy a stock, you buy a stock for a price. That price is known as the market value. That's the price of the stock that it's currently being bought and sold for in the marketplace. Where is that marketplace? That is the securities exchange. That's where different stocks are listed, is on an exchange. There's the NYSE, the New York Stock Exchange, NASDAQ, and the Amex, the American Stock Exchange. Typically, the NASDAQ Stock Exchange has a lot of technology companies. If you ever watch the news, you'll see people that a lot of the financial newscasts will reference the DJIA being up or down a certain value, the S&P 500, the NASDAQ. These are known as indexes. An index is basically a benchmark that's used to judge the overall performance of how the market is doing. So the DJIA, the Dow Jones, is comprised of 30 very valued companies in a variety of industries and sectors. Some of the components of the DJIA include 3M, Caterpillar, the construction company. I believe Home Depot's on there. So it's a wide variety of companies that are on there. The Standard & Poor's, another index, and that will include the S&P 500. There's 500 companies involved in that. And the NASDAQ composite, that's going to take a value of certain companies on that NASDAQ exchange and give an overall performance of how they're doing. A lot of times what happens with these, the value of the index, if your stock is listed on the New York Stock Exchange and it's related to the Dow, you can see if that value has gone up during a typical day. If your stock is on the New York Stock Exchange and involved in the Dow, a lot of times your stock will go up. Same with the NASDAQ. For example, Apple is listed on the NASDAQ Securities Exchange. So if you see how the NASDAQ did overall in one day, a lot of times that's a good indicator as to how your individual stock did. Next is the two ways that people will classify the overall market. There's the bull market and the bear market. The bull market is a period of rising prices. There's a general feeling of optimism. What that means is there's a lot of people buying stocks. It's a very positive time. A bear market is the opposite. Stock prices are falling. A lot of times what happens when stock prices are falling, that means a lot of people are selling the stock, so then the value of the stock is decreasing. During a bear market, there's a lot of times there's a pessimistic feeling. People are feeling very negative because the stocks are decreasing in value. This slide includes a variety of investing strategies. There's short-term and long-term strategies. These two short-term strategies that are listed here, buy on margin and sell short, these are very risky techniques that you can do. What's happening when you buy on margin is you are basically borrowing money from your broker in order to buy stock. It's what's known as leveraging. It's a very, very risky technique to do because once the broker calls and requires that money back, you need to pay up whether your stock has increased in value or not. The other type of short-term techniques is selling short. A lot of times people think sell short has to do with holding it just for a short period of time. Yes, that's true. However, it's the opposite of when you're buying stock. When you sell short, what's happening is you are, in a sense, selling the stock in hopes that the value is going to drop. So, for example, if you decided to sell short a stock, you would be loaned, say, a certain number of shares of the stock. And if that price was $20 and you felt as though that stock was going to drop in value, you could sell short a share for $20. So you have received that $20. However, there's one share of stock outstanding that you need to replace. Hopefully, if the value goes down, then you can rebuy that share and then return that share. It's a very high risk technique. The other long-term techniques, these are the ones that people are more familiar with because this is how the majority of investors will buy and sell stocks. Buy and hold, this is exactly how it says. You're going to buy the stock and hold it. This is a long-term plan. You're hoping to buy it and hold it for many years and that the value will increase. And hopefully with some stocks, they do what's known as a stock split. What happens is when companies realize that the value may be getting too high, they could split the shares. So for example, if you had stocks that were valued at $100 per share, the company may decide that that $100 per share is too expensive. So instead of having one share for $100, they could split it to be two shares worth $50 each. So you still have the same value in the shares, except now you have two shares instead of one. Dollar cost averaging has to do with buying the same dollar amount of stocks over a period of time, and basically you are averaging the price by the number of shares that you have. Direct investment is another way of investing. You are buying it directly through the company rather than through a broker. The last long-term technique is known as dividend reinvesting. As I stated earlier, some companies pay a dividend. A dividend is kind of like interest. They're paying you as like a thank you for holding that stock. So when you initially buy the stock, you get the option to decide if you are going to reinvest your dividends, meaning instead of getting that amount of interest or that dividend in cash, your broker will take that cash and buy a percentage of a share. So instead of getting cash immediately, you're earning more shares. This is a great long-term technique. If you're planning on holding that stock for a long term and it pays dividends, dividend reinvesting is a great thing to do. That's it for Chapter 11, Investing in Stocks. Again, make sure you read up on everything. Have a great one.